Fed Governor Waller warning just moments ago about the need for more caution when it comes to lowering interest rates, though he says the economy is on solid footing. My next guest expects a soft landing, which could make way for a year-end rally. Joining me now at Post 9 is Warren Pies of 3Fourteen Research. Warren, great to have you here.
Yeah, great to be here.
Thanks for coming by. So, this gets at this equation. Waller talking about, what pace of cuts we might see. The don't fight the tape, don't fight the Fed rules still seem to line up bullishly. But what about this adjustment to yields and to Fed rhetoric?
Yeah, to me, really, when you step back, rates are one of the big risks to markets. So thinking about long-term rates in particular, I think a lot of the rally we saw from mid-year was fueled by rates falling a little bit. And so when you think about what Waller's saying, he's saying neutral, we have a lot of room to cut before we get to neutral. Yeah. But I think maybe the market has it wrong a bit. So if I was trying to pick a concern out, I would look at that and say, look, the Fed just cut 50 basis points and rates ripped on the back of that. So if we do a thought experiment where we say the Fed came out tomorrow and they took the Fed funds rate down to 3%, which is say what they think neutral is, what happens to the 10-year? I'm not quite sure that the 10-year actually goes down in that scenario. And so I think that's a risk the market is going to have to work with and struggle through here as we go out to the end of the year and into 2025.
Yeah, those long-term yields have risen, of course, along with market-implied inflation expectations once the Fed cut, but also the economy, the numbers coming in a little bit firmer than expected. So I guess, is there a level on yields that you would get more concerned?
Yeah, our view, we've done a lot of work on this, is that it's not so much about a level, it's more about rate of change. And so at this moment in time, given that where we came from, we look at really a 63-day window, which is 1 quarter. And if we were to see a quick move up to 4.15, 4.2 on the 10-year, I think historically, at least going back to 2022, you start seeing the market get some indigestion. So it's less about a level and more about the pace of the move in rates, and the slower move in rates seems to be that stocks can digest that. Just like earlier in the year, we had rates rising, market rallied, and so it's really about the pace. That's what we want.
So if that's potentially one of the visible risks out there in terms of what happens on rates getting a little bit unanchored, what's the baseline from your point of view in terms of the market have it right here in terms of saying, look, the Fed's easing into a earnings recovery and all the rest that we've been talking about?
Yeah, well, that's the big picture. Yeah. We keep oscillating between growth scare and now we're seeing a reacceleration. And if you zoom out, that is what a soft landing looks like,
exactly,
right?
Yeah.
That's the back and forth that a soft landing looks like. So we're still positive on the market. And when you look out to year end, it feels like we're pretty bullish, right? But strategist targets are 6% out to year end below where the market trades right now. If you go back to history, on October 15th, historically, that's the most bearish relative to the market that the strategists have ever been. So when I look at it, there's still fuel for this chase. And that's the dynamic we've been playing all year, is that we think that strategists were too bearish, people were too underpositioned coming into the year, and they're going to continue to chase that market. And that takes us to next year. I think when we turn the calendar next year, it's going to be about valuations and rates and things like that.
Yeah. It's interesting because in the first half of this year, folks who were underinvested or didn't think the market could do a lot to the upside were kind of resorting to saying, well, but it's such a narrow rally. Is it really as strong as it looks? That's been really undermined over the last 3 months, right? You had a broadening out. The mega caps have really reset on a relative basis, and they've kind of, maybe the market's in better balance. Where from here do you think that dynamic goes?
Yeah, well, I think a big part of the broadening out has been a rate sensitivity story. And so I would expect to see some mean reversion where the cap-weighted S&P 500 starts to outperform equal weight through year end at least. I would avoid, given this period we're at, where I think the bond market is kind of pricing out that recession risk that it had priced in from mid-year. I would avoid the utilities and real estate and rate-sensitive sectors right now, and I would be looking more to buy into high-quality tech that's been pulling back and has really kind of reset sentiment in a lot of ways. And so that's our playbook. I think you have to go back to something more of the dynamics we saw first half versus Q3, where market big cap tech outperformed in some of these other areas versus rate sensitivity.
Pendulum swinging back possibly.